And good day, and welcome to a new edition of Ocean Freight TV. I'm your host, Steve Ferreira, and welcome to the palatial studios of the Recover Now operational offices here at Ocean Audit. It's so great to have you here today for a worldwide audience on LinkedIn. And we have a truly great show today. I dubbed today's show as Run Silent, Run Deep. And I think it's just so appropriate to have bombs bursting around us, but yet we're in a safe, protective submarine container hybrid bubble. So this is a new invention of mine. Sorry, guys, I don't think this is the best way to transport freight going forward. But I do think this is going to be a really interesting show. Again, hi, everyone. I'm Steve Ferreira, CEO of Ocean Audit here in Miami, Florida. Again, welcome to the Recover Now studios at Ocean Audit. So glad to have you on a new show today. And, I was thinking and reflecting on today's show, wanting to bring you the latest and greatest in contemporary news and updated news around the world in container shipping, and couldn't think of anything better to do to start off today's show with talking about Maersk Line and the fact that they came out today with their earnings. And most importantly, I think the most important perspective to share with you on what Maersk said today, according to Vincent Leclerc, their CEO, is that they're actually bringing down their guidance on container volumes from it was going to be 2.5% for 2023. Now they're saying it's going to be a drawdown of about 4%. I think that was most importantly is no significant drawdown of destocking or destocking of BCO inventories. They don't see that happening, i.e. Maersk does not see that happening right now. And they actually make a comment that they see it happening slower in the US or North America than in other parts of the world, which to me is a very interesting sign, because it tells me that perhaps the rest of the world has a better storyline, or maybe didn't go obviously hog wild on extra imports during the container-geddon periods that would have led to destocking. Now, keep in mind, right, that destocking is not necessarily a container-geddon esque issue, right? We also had the combination of we had Trump tariffs, where we had stock items like vinyl tile, right? White vinyl tile that doesn't go out of style for 10 years. Lots of stock items were brought in to lots of warehouses, and a 4 or 5 year period. Yeah, I get it. You try to get rid of that old stock. But we have had a series of events, obviously, that led to an overstock issue. Of course, the pandemic and container-geddon being the predominant one. But it's really interesting to see, the Maersk results today. The analysts, the Maersk stock slipped about slightly today, 4 or 5% down in overseas trading. I think that analysts had level set the expectation that, hey, it wasn't going to be a great quarter for Maersk. But when you talk about that, the number, for example, their revenue was 40% down, this period over the same period last year. That's really a BS number, right? Because if you make gold and someone takes a few bars away from you, you still have a ton of gold. So it's hard to compare apples to oranges, and that's one of the strategic problems. But I think I wanted to try to distill it down for my audience today to talk about the major issue on guidance, which kind of leads me to believe that Maersk never really saw a peak, and it kind of reaffirms, it certainly does reaffirm the fact that the issues are more centered right now around the fact that there's no peak because of the issue of destocking. Now, I put together this next slide on destocking to kind of show you that, hey, obviously we're lacking a peak right now. But is it really an issue purely on destocking, or is it a double-edged sword in the sense that, obviously, if you feel like the stock market like I do, right, you try to dollar average down your costs, and, obviously leveraging lower ocean costs from $22,000 to $2,000 makes a heck of a difference in terms of how you allocate or aggregate that ocean freight against the expenses of, a million pieces of ladies' sweaters, or, a million pieces of vinyl tile, right? So, you can always get your costs down to these ridiculous amounts. Now, what it appears in terms of Maersk's comments is that they perhaps may be hinting that this problem will take care of itself more towards the end of the year. So could this potentially mean and I like to hear from my retailer friends and supply chain experts out there. Could this mean that we'd have a huge 2023 Xmas, Christmas season, to kill it off? And when I say to kill off the excess of destocking that's currently existing in warehouses all around the country. And may that be the potential end that we know it of this particular era. So I think that obviously the winners and the losers of this game are going to figure out, how to do this, the destocking properly and orderly, what to write off, what not to write off. Certainly depending on the type of commodity, a high-end furniture item versus say a low-end toy. You've got other issues, and there's liquidators out there that obviously creating their own environments with living off of the potential destocking phenomena. So it seems like this is an issue that needs to level set itself and kind of come back into the forefront as we start to work through the next problematic issues of the ocean freight industry. And it's sort of like, I look at this as sort of like the little Dutch boy. And it's like, okay, this is always one of my favorite analogies, is that, in my line of work, for example, ocean freight auditing, a customer often asks me, well, hey, Steve, let's look at, the last 6 weeks of invoices. And, if we see a trend there, then, that means we can go back, right, 3 years. And I say, yes, we can always go back 3 years. But ocean freight is a lot like the little Dutch boy plugging the leaks in the Holland, the dams near the windmill. Because, what happened yesterday or 2 days ago doesn't replicate itself in what happened 2 years ago or 18 months ago. And so you can kind of look at the theories of what a lot of importer exporters do in terms of looking at cost containment, right? We're going to talk about that in a few minutes. Leveraging lower ocean rates, but why not kind of multitask it, right? Very rarely do I see the headlines go together. So-and-so is looking to leverage the incredible ocean rate generosity, or generosity is the wrong word, the state of current ocean rates in 2023, and cost containment or cost improvement strategy, right? It's really weird. I'm going to talk about some of the headlines that we see in the media. And I was really shocked in preparing for today's show, just how little play this gets in terms of where the market is. And it kind of falls into not only where the market is, but where the stock market is, right? I mean, you see what I did here on this little slide here, ocean freight destocking, right? So I kind of like struck through the D and the E and the ing, and we were left with ocean freight stock. And we got the bull and the bear playing with each other there, trying to, obviously who's going to dominate. But I think it's poor media optics in terms of how the media and press is playing through what BCOs, importers, exporters are going through. And I think that the lack of attention is that, hey, it's not like an importer or an exporter is trying to hide, especially publicly traded, from you what they're doing and not doing, in terms of, say, cost containment and improving ocean freight strategies, because, it's in their annual reports. And it appears to me that because of that, certain importers could be ready to soar higher, both in terms of looking at their stock and, what their earnings surprises might be in looking at Q2 earnings, because it's really the first quarter that you have kind of that full Monty effect, that full effect of, really much severe drop off on ocean rates versus the same period last year. And I'll give you a couple of good examples on this. So you talk about, we talk about some of the headlines, right? So the media optics are, and again, I'm going to read you I looked on Sonic GPT, Chat GPT, Google. I try to get you the most current headlines that would give some flavor to this particular slide. And so, I like Paul Berger very much of the Wall Street Journal, and but there's a report from March 25th, right? The headline is "Retailers Reaping Big Savings on Ocean Transport Costs" by Paul Berger. Great article that Paul wrote. Then he wrote another one a month before that, on February 14th. "Retailers hope to bargain for lower ocean freight rates." Again, that's kind of playing into the TPM. And then we have a really kind of interesting one, even a month earlier, Jo-Ann Stores, Jo-Ann Fabrics, also known as Jo-Ann's. Jo-Ann's $200 million cost reduction plan relies on falling ocean rates. Very, very good for Jo-Ann. I know a lot of the people there and the smart people, and they're really, I think, jumping in on something that is the storyline here. So Jo-Ann is talking about cost reduction, right? And they're talking about leveraging what would be great ocean rates. Now, when this was written, I bet you Jo-Ann's, and this is 6 months old, what I just wrote to you about, read to you about Jo-Ann's. I bet they never anticipated the fact that, even incumbencies within ocean freights would be fighting for, even lower rates. So in other words, if you have, ocean vendor X and you're at 2,500, then you get them to go to 2,400 and 2,300. You start leveraging what that means, down to the SKU point. What's the cost, the ocean freight component, per unit, and then how do you treat that markup in the retail stores? And then so you say to yourself, well, hey, okay, maybe the consumer. And again, I say this with peace and love. I'm not saying this about Jo-Ann's or any retailer. But, the retailer takes advantage of what cost components they get based on where the markets are on ocean rates and obviously what they can buy the product for. But it doesn't necessarily mean that all of a sudden, if the ocean rate goes down a couple $1,000s or incrementally in their favor, that gets passed on one-to-one to the consumer. Now, what it might do, right, is going to help certainly the destocking process, right? Because if you can dollar average all those higher costs and get it down to lower. Think of it like this. I have a container for $25,000. I have a container for $2,000, $27,000 on 2 containers, $13,500 landed cost. Bingo, bongo, bango, right? I'm kind of back in my sweet spot where I'm starting to say, okay, I can survive this. And I think this is the mentality. This is the proper mentality that BCOs and the trade need to start focusing on. I don't see anything about it. So you're hearing it live here. And again, just to kind of have our new listeners, I'm Steve Ferreira, CEO of Ocean Audit and Ocean Freight TV, coming to you live here from Miami, Florida, from the Palatial Recover Now studios. And I do, as my day-to-day job, ocean freight and global logistics refund recoveries, both from a post-audit and pre-audit perspective, going back 3 years in time to help BCOs recover overpaid, overbilled, misaligned, inappropriately charged ocean freight, detention, and demurrage items. So when you talk about all that, and you talk about the optics that are involved, you talk about importers that are ready to soar. We already talked a little bit about Jo-Ann, but the import spotlight that I like to talk about a lot, because I think they're and I say this again with peace and love. I think that Dollar Tree, is a great poster child for how this is all playing out in their favor. Now, obviously during Containergeddon, and I'll read something to you from Dollar Tree's annual report. It's really, really fascinating. So in the Dollar Tree segment, we raised our primary price point on merchandise to $1.25 in fiscal 2021, right? So they have very low cost items, right, at Dollar Tree. And obviously the $15,000 and $20,000 and $25,000 ocean freight rates at Containergeddon really hurt Dollar Tree's earnings and obviously the momentum in their stock. Now, this applies to everyone, but there are obviously retailers, importers, wholesalers, distributors that are much more sensitive, towards the ugly sins of Containergeddon, and then obviously the healing process of, for example, dollar cost averaging, the destocking process, as I alluded to a few minutes ago, by taking the old $20,000 rates and combining them with the new $2,000 rates and finding a way to then enhance that with cost reduction, such as, and again, post-audit recovery of overpaid ocean, overpaid trucking, overpaid air. There's so many different ways to look at cost containments. That's why I'm such a big fan of what Jo-Ann said some months ago, where their CFO, was obviously, right on the ball that he's going to take advantage of cost containment, whatever they can reduce cost-wise, and whatever they can take advantage of going forward in the future. But I wanted to read to you again from Dollar Tree's annual report. This is really fascinating. So it talks about their purchase obligations. So in January, as of January 28, 2023, we have commitments totaling 300 million related to ocean shipping contracts and commitments related to the go forward ocean contracts that they have. And so if you look at that, right, that's 100,000 containers at, say, a $3,000 increment. But during the ugly days of heady days of Containergeddon, that would have only been $15,000 a container. I'm sorry, 15,000 containers at, say, 20,000 or so odd dollars per container, right? So it's almost like, in some ways, Dollar Tree is getting 85,000 free containers to move. So when you look at the key process within the Dollar General financial explanation management hierarchy decision making, when they write to Wall Street how their costs are allocated, there are 5 or 6 bullet points that they focus on. Actually, probably 7, but 3 of them are shipping cost, shipping disruptions, and then labor and port disagreements, at the strikes or any kind of labor shortages or snafus at, West Coast or East Coast ports. So I won't bother reading, within each of the bullets their focus on it, but there are out of the 7 major bullets that talk about their costs and the troubleshooting that might happen, 3 of them are related to ocean. So here's the deal. When I look at the spotlight, for example, on Dollar Tree, I know they have their earnings at the end of August, right? And again, I'm no expert. I just do this for fun in terms of analyzing, the import markets. There's no one better, obviously, in the market. With my 40,000 outlier hours, I mean, I'm the guy on data, I'm the guy on audit, I'm the guy on cost control, I'm the guy on process improvement control, I'm the guy on getting you refunds. But I look at Dollar Tree and I think to myself, holy cow. I mean, could they potentially just surprise the world on their earnings? And because the ocean freight component was so favorable to them, could their earnings just explode? It could be. And again, I'm no expert in the stock market. And as I said, your mileage may vary. And I'm just showing this and saying this for fun. But, I took a look at the so many great friends I have over at S&P Global Marketing Intelligence Journal of Commerce. And you look at the top 100 importers, top 100 exporters, so many huge names out there, Ashley Furniture. I mean, could Ashley, they sell less, more high valued items, but I mean, the profit points are improving. The profit points are improving, rapidly and dramatically. So, I mean, Ashley could benefit terrifically. It's really one of those things where it really doesn't matter what the commodities are. So I think that we have to really look at how that plays into our scenario, and looking at each of those publicly traded companies, and their outcomes could be spectacular, right? And that could be, a return to investors. It could actually be a return to confidence in consumerism, especially if they start to look at focusing on the destocking issues towards the end of the year, which, again, take Maersk as a beacon or as a source of light, where you could potentially see the Maersk folks being right on that. And I didn't say what happened. They didn't say what happened during Christmas, but I mean, they did say that they expected it or anticipated it to happen. So I think that's really good news. And you start to look at where we go now from here. It's focusing on really, really tight controls from the controller, from the CFO, from the procurement professionals, because ocean freight rates don't look at this point like they're going to jump up dramatically. So now it's a question of massaging them. How do you massage them within the destocking process, the cost containment process, and really the go-to-market and process improvement? Now you have a lot of retailers, I mentioned Dollar Tree. Another one might be like, for example, I don't know, Five Below. So you've got a lot of them out there that are publicly traded, and I'll tell you, just in closing, one of the big ones that happened, it was so silent, nobody said anything about it, but All Markets, which markets under the name of Vita Coco, right? It's coconut water. their stock the other day, they declared their earnings, and they specifically said that our earnings are improved because of favorable ocean freight rates. And I believe it was like a 1 cent or 2 cent in terms of profit improvement on the diluted earnings. But just think about that. If the ocean rates were so unfavorable, that could have been a negative loss of X amount of cents. Instead, it was a positive gain. The market didn't anticipate that. And the stock actually went up at one point from, I think, $25 to $30 during the session. And it ended up settling back down to a more normal level. But that's not the point. The point is that the market was surprised that the efficiencies on the earnings were coming back because of the more attractiveness of the ocean freight rates. And so I think that when you look at what's happening ahead, those are some of the keys, Steve's keys to success that I look at. And, obviously, just in closing out, I think that you look at, and I really appreciate everyone for watching, today's show, but I think that the opportunities that present itself with regards to what we're doing now here at the Recover Now studio at Ocean Audit, averaging $1 million a week in refunds and cash contributions back to beneficial cargo owners. I'm looking at a stack on my desk. There's two containers that I just achieved a $30,000+ refund on detention and demurrage. And so you're starting to see the traction that thought leaders around the country are starting to say, hey, we really need to kind of focus on get the goods while the getting is good, on the healing the deadly sins of post-container getimism, and then moving forward with the next matter at hand is obviously destocking. And I think we spend so little time talking about the dollar averaging of our costs from very high to very low. And then when you think about that, let me just add you one last thing in closing out the show, is if you think about the average refund that we're seeing now on a container from the 2021 session is about $3,000 or $4,000 a container. Okay, so let's take that again. Let me try to do the math in my head. So we have a container at $20,000 that we paid. We have a container today at $3,000. So it's a $17,000 delta. So that's $8,500 average. If we take that the higher container and we take off $3,000 or $4,000, so we've got say 17,000. Let me do it again. So 20,000 and 3,000. 23,000 divided by 2, 11,500. So we take 20,000 minus 3,000 refund. We've got 17,000 and 3,000. We've got 20,000. We've got 10,000. So we're able to really continue to get our profit and our costs lower by doing ocean freight post-audit and ocean freight refund recovery on the old stuff. And that's one of the biggest challenges, is that BCOs are starting to, I say with peace and love, right? Everyone's kind of got these blinders on, horse blinders on, where we're moving forward. And it's like 2,000 ocean rate. We got to figure it out. We got destocking. Hey, but right in front of you with a quick, 30-minute setup process, you can recover $1 million. That goes to costs. Now, Joanne said they're trying to have a $200 million cost enhancement. They'll get there over time, but little steps first, right? You work on the ocean, you work on the parcel, you work on other increments, the trucking. So the ocean freight is the biggest single ability right now for BCOs to recover now. And that's why we're sitting in the Recover Now studios and bringing you this quality content. So I hope you like today's show. If you have any questions at all about the show, the content, any follow-up, anyone that would like to engage with me in talking about your own specific ocean freight and global logistic refund, don't hesitate to click the button below and follow me on LinkedIn, or message me at one of our brand new premium emails, which is stevef@freightaudit.com. That's right. We have the best domain in the business, freightaudit.com. Of course, that points back to Ocean Audit. And I look forward to hearing your questions, thoughts, and most of all, I look forward to helping you get the cost containment recovery money that is likely and necessarily due back to you from the overcharges and overpayments and misappropriated invoicing that your ocean vendors, 3PLs, 4PLs, truckers, detention, demurrage, and terminal billing parties bill to you incorrectly. Let's recover that now. And again, In closing, I'm Steve Ferrero from the Recover Now Studios at Ocean Audit. I look forward to our next session. And until then, have a great weekend. And thanks for tuning in. Cheers.